What would happen if the trillions of dollars that were printed over the last few years started to make their way into the economy? Well, you might want to sit down and watch this video. Let's begin. We are talking about the Federal Reserve here. I'll show you several charts in a row, and that will give us a little bit of background as to what's happening now. I'm showing you the Fed funds rate. The Fed funds rate, that's interest rates of the United States. And I just wanted to point out the fact that the pace at which they are increasing is historically very fast. Okay, while we are at the bottom still compared to where we were many years ago, the pace at which they're increasing is fast, and perhaps they will turn that around in the coming months. But as of this time, we are currently sitting at around 2.5%, and that's a range, of course, but this is not taking into account the amount of money that was printed. So they have this thing called the shadow funds rate, shadow federal funds rate, and essentially it takes into account how much money has been printed at the same time. We are, as of earlier this year, it stopped around February 2022. Look at this. This is provided to us by the Atlanta Fed. You could see it for yourself on their website. Links are in the description as always. And essentially, as of February 2022, the effective federal funds rate was basically zero. Basically zero. The shadow rate was 0.21%, basically zero. Prior to that, all throughout 2021, this was in the negative because we factor in the stimulus that's provided. So keep that in mind, okay? Look at this. These are the treasuries that the United States has right now, the Federal Reserve has of the United States, and you could see that we have started to come down. Not much, but it certainly has. What has not come down are the mortgage-backed securities. So this is 2019 into 2020, and you could see it was declining. They were starting to wean off of that. And then suddenly, we need to take care of this. We're going to buy a whole bunch of toxic assets. And so they started to print a whole bunch of money and buy these up. Now that peaked, and it hasn't declined at all, even though they said that it would. Now, September is a month in which supposedly things will change and they're going to accelerate this policy, but we will see what happens. Why can they not get rid of their mortgage-backed securities? I think it's pretty obvious, but I'll say it anyway. And that is nobody wants to buy it. Nobody wants to buy it. It's like having a stick of dynamite that somebody hands you that's already been lit. No thanks, not going to touch it. Then we have this. You can look at the reverse repos. Many people wanted to look into this, and we have somewhat peaked over the last couple months. This is from June, peaking at around $2.3 trillion every single day. Banks, think about this, reverse repos. Simple way to explain it. Banks, instead of loaning cash out to different people and businesses, they just park it at the Federal Reserve and get an interest rate back to them overnight. That's basically what it is. And so it tells you what the banking system believes in the security of this current system. Isn't that odd? Isn't that unusual? Now we have the velocity. So you've got all this money printed out there, $9 trillion on the balance sheet. We've got the interest rates. I broke it all down. But what about the velocity? The velocity of money is something very important. And would you believe that this has started to pick up to a great degree? Now, when you look at it compared to where we were years ago, okay, certainly, but when we have to look at this in a year-over-year change, it starts to give us an interesting perspective as to where we could be heading. Rising inflation fuels rising velocity. And this is the black line being the US CPI year over year. We know that has grown tremendously. And the blue line is M2 velocity. M2 is, one way to take a look at how much cash is there in the system. What they note here is that in the 1970s, they were marked by high velocity and high inflation. And here, inflation and velocity both high again, at least in year-over-year terms. We have this. Collapsing velocity and the rise of reserves, showing us throughout the period here, basically 2000 up until this point, You look at that, velocity collapses as reserves mushroomed in the age of QE. So what you have here is that the whole bunch of cash is being put out into the system, but it's not really out there in the economy. It's not people taking out loans, people buying homes, businesses getting out there, taking risks in some cases, things. It's really not the case because you've got this huge tsunami of cash that was trying to flood in but couldn't. So what happens then when it finally does? Well, if it does and does continue to do so, then we enter a period of extremely high inflation. You might be saying to yourself, well, based on any measure, inflation is already high. What do you mean? Well, if you think this is high, well then, it's going to be a whole nother world. We could enter a much higher level of inflation, dare I say, hyperinflation, if the cash actually makes it out there. Now, that's a big if. That's what needs to be known. Okay, you can see right here on the right side, velocity is finally rising again. So the last time, if you look at this right in here, you see how it picked up? By the way, the pace at which it's increasing is faster than what it did in the previous instance. What is this period here? This is when they started to tighten, if you remember. That's right. Interest rates started to come up, and the balance sheet was started to not decline, but just held flat. And then when the balance sheet started to decline a little bit, that's when you had velocity pick up even further. Interesting, right? That's what's going on today. And of course, you're not going to be able to see that right here because we're just at the beginning of it. Who knows what could happen in the coming days, weeks, and months. More bank lending on the way as velocity rises. I'm interested to see it. This is the C&I loans, commercial and industrial loans, year over year, as well as the M2 velocity. And that is something that remains to be seen. Are we heading into a recession? Are we entering into a period of hyperinflation? I mean, I can't predict the future, but I can certainly show you the data and the way that this brings us to, the historical sense behind it. What does this all mean? You're going to have to understand that when you print money, you devalue a currency, and people start flooding or rushing, I should say, into real goods, into real assets, into things that are tangible. And that's just the way it goes. And by the way, if you look at nations today that are encountering very high levels of inflation or hyperinflation, do they necessarily buy the absolute best assets and buy them at the right time and all these things? No. They may buy cars. They may buy anything because it's better than cash. I mean, this is happening today in so many places. They rush to buy anything. And that's what I want to make sure and really hammer this point home, that eventually the party comes to an end. Eventually, all of their schemes and scams are actually going to affect people's lives in a negative way. But what we're seeing right now isn't because of 2020 up until now. It's not because of a few trillion printed, though it was excessive. It's because of everything that happened before it. All the madness from 2008, all of the previous cycles, all the way back. You could say it started in 1913. That's a pretty good place to start, as I have, by the way, right here on the board. If you could see that, there's a reason for this 3D rendered background, although it does trigger a lot of people. So this is a CNBC article here. I thought it was funny. Janet Yellen, your favorite and mine, quote, "We just don't have conditions consistent with a recession." Yes, that's right. Janet Yellen, our favorite, doesn't see this as cause for concern. Okay. But what about the euro area? Well, according to Reuters, the eurozone inflation outlook has failed to improve since the July rate hike. ECB board members suggests that she favors another large interest rate increase next month, even as recession risks harden. You see, you can't stop it. You can't, especially with these small interest rate hikes, that you're going to be able to actually like stomp on these flames. It's not going to happen. And so everything we have seen so far is a cause for concern to anybody who is really overextending themselves. I would be very careful if that's you. Before the problems arise for you, please try and get your situation in order. Have some income coming in the side. How do you do that? Well, you take the skills that you have today. It doesn't have to be a passion. If you love to be a photographer, maybe it's just not going to bring the money in for you. Okay, you love to take pictures. Is that going to bring the money in? If you can, absolutely. Absolutely. But maybe you had this other skill. Okay? You're an electrician. Can you use that skill to bring in some money on the side? If you can, then do it. Make it happen. Take that cash and deploy it where you think is the right place. Maybe that's paying down your mortgage. Maybe that's to invest in something. Maybe that's to get certain preparedness products. Maybe you want solar panels. Maybe you want geothermal heat. Anything. Anything that you think is the right thing to do. Depends on where you live, depends on your current situation, family, and so many other things. Please get prepared, know what you're doing, and of course, always stay informed. I'll see you on the next one. Take care.